Hey guys, it's Sasha. This morning, 30-year gilts in the UK have hit 5.4%, setting a new high in almost 30 years, and this is a very big problem. Let me explain what this means, why it is such a big deal. In the last few months, 30-year bond yields in the UK have been going up in a vertical line. This is the interest that the UK government has to pay on bonds that it issues to new buyers. Gilts and bonds are just different words that mean the same thing. It's the money that the government borrows from people to fund stuff. Because the UK government has a deficit, they have to borrow money to fund the money that the government spends. The debt pile in the UK has gone up to over 100% of GDP recently, so the amount of money that the UK owes is now greater than the total sum of the value of all the goods and services that the country produces in an entire year. And this debt is made up of a whole load of different things. Some are very short-term bonds, some are very long-term, like these 30-year bonds. And the 30-year bonds, they're more of a representation of what the market thinks about the long-term impact, the long-term view of what the UK economy is going to do. And whenever this different terms of debt comes up to the due date, to the point where, the debt has to be repaid back to the person who gave it, the government has to repay the bond. And because the UK government does not have any money, because they run a deficit, they have to borrow the money to pay back the previous people that they borrowed money from. So they go and sell new bonds to collect money to pay off the old bonds. It's a bit like taking out a credit card, marching down to the nearest cash machine, withdrawing up to your credit limit, the maximum amount possible on that credit card, and then taking that cash to a different bank so that you can pay off the previous credit card. Obviously, this makes complete financial sense. It is incredibly good to do this kind of thing, but here's the thing. In the UK, the Bank of England sets the base rate in the country. It is similar to, but not quite the same thing as the federal funds rate in the US, although people kind of compare them. They're not exactly the same thing. The UK rate is the rate at which the Bank of England charges banks for overnight loans. So if a bank borrows money for one day, that is the annual interest rate that would apply. In the US, it is the rate at which banks can lend money to each other overnight without using collateral, including the central bank. So in a way, the bond yields should and do correlate with the Bank of England rate. But when you buy a bond as an investor, especially a 30-year bond, you're really trying to guess, what is the economy going to do over the next 30 years? How much interest do you want to earn relative to what your expectations on the interest rate, on everything else are for that 30-year period, right? So the government goes and holds an auction. Literally, all the investors turn up and they bid how much interest they would like to receive on these bonds. And the Treasury have to take the lowest available rates to get enough cash to pay all the bills. And at the moment, the rates that are being charged by the people taking part in the auction are increasing very fast. And you can think of this as a little bit like how a normal loan works in a way. If you are a very low-risk customer and the bank is absolutely certain that you are going to pay the money back, no matter what, if the economy worsens, everything's going to be great, the risk is pretty low, you can get a loan at a very low rate. When the interest rate was low, you could go and get a loan for 1.5% or 2% interest. That was very, very cheap, right? But if you are a high-risk customer, if you have bad credit history, maybe you don't have any credit history at all, or a limited credit history, whatever, then you have to pay a lot more interest. You might have to pay 5% interest, 10% interest, 20%, 30% interest, or more, depending on your particular situation. Because there is a greater risk that you will not pay the money back, right? There is a greater risk that the investor will lose money. Now, the risk of not paying the money back by the UK government is low, because the government can just go and print money. That's something they can do. It will break the economy, but they can do it, and they sometimes do it. But there is still a risk associated with lending money to the government, because you might not get as much money back after you account for inflation, etc., different exchange rates, as you have put in. So that's the risk. It's just a slightly more complicated version. So it's factors like, what will the pound do compared to other currencies? What will the exchange rates look like? What is the inflation in the UK going to do? And what will the inflation do in other countries at the same time? How much will the UK economy grow compared to the economies of other countries? And by the way, I'm going to be discussing how to invest in a bad economy in the next live session in my course. That's tomorrow on Thursday afternoon. The live sessions are all recorded, so you can watch them afterwards as well. And the course is currently on sale because it's January. You can get a 10% discount before the 15th of January. Use my code HELLO2025 at the checkout if you want to join. The link is in the description. There's a whole load of content all about investing in the stock market. Go and check that out. Now, in the last couple of years, the market thinks that the risks associated with the UK economy have increased substantially. That's what is being reflected in the rates going up. So you can see the 30-year bond yields have been going up very fast recently. Incidentally, this spike here in 2022 is the Liz Truss spike. That's when everyone absolutely lost their shit and Liz Truss was forced to resign very, very quickly. And you can see that the rate now is quite a bit higher, but nobody seems to really care because, well, of course, this has absolutely nothing to do with politics, right? It's all in the numbers. It's not even like Liz Truss was responsible for the entirety of this big spike here. She only became Prime Minister on the 6th of September, which is roughly here, most of the way up this vertical line. So she didn't really have time to go and screw it up. The screw up started long before she turned up. In a little over a month after she took office and that mini budget, 30-year gilts went up 1.3%. The increase by this Labour government is much slower, and in the last 4 months it's gone up 1.1%, but they did have a much higher starting point, so there is that. It was already screwed up, they're just screwing it up a little bit more. So the Treasury went out and sold 2.25 billion of this 30-year debt at 5.2 interest at this most recent auction. This is the most expensive debt that the UK government has taken on since 1998, 27 years ago. And the issue for the new UK government that we now have is that they set themselves a rule that by 2029, the end of this parliament, the government should earn more in tax than they spend day to day. Now, day to day spending is defined by the government as all of the government spending except investment. And to start with, this is an incredibly dumb rule, because what exactly is investment? Is building new hospitals and refurbishing existing hospitals day-to-day spending, or is it investment? Is fixing potholes in the roads, is that day-to-day spending, or is that investment? Is fixing crumbling schools, is that investment, or is that day-to-day spending? A large amount of regular day-to-day government spending that has to happen, there is no option for it not to happen, could be classified as investment, so that the government can then exclude it from the total spending pile and then claim to have achieved this completely pointless target. But anyway, when Rachel Reeves announced her budget, using the projections from the OBR, the gap that she was playing with in 2029, so in 4 or 5 years' time, was £9.9 billion. That's the gap between the amount of money that the government is going to bring in via tax and how much they're going to spend in this day-to-day spending, so not investment. The budget for the current financial year sits at £1.3 trillion. So that £9.9 billion is about 0.8% of the current budget before you account for inflation and growth between now and 2029. So if the economy grows just a tiny bit more slowly, or the tax take is just a tiny little bit less than what the government is projecting, then they will fail to meet this target. And currently all of their projections and expectations are extremely optimistic, in my opinion. And if they miss this target, that means that the day-to-day spending will still be higher and will not be covered by taxes, and they will have to continue borrowing money. And this is a little bit of a chicken and egg problem. In the current financial year, £105 billion is being spent on just the debt interest. So almost 10% of the total budget is just paying the interest on the debt that the government carries. Now, this chart was done a little bit before, a few months ago, and the recent increase in bond yields has not been accounted for. So it's probably going to end up being a bit more than this. But the point is, Confidence in the UK economy is deteriorating so fast right now that the UK government is now having to pay more and more and more to borrow money to pay off previous debt where they had to pay less and to finance the budget. The OBR does its forecasts twice a year. The next forecast is coming in March. Now, I am frankly not sure why this is not something that happens continuously on a monthly basis. You know, we're a serious modern country with a modern economy. There are thousands upon thousands of people working in all of these kinds of economist jobs in the government or pretend economist jobs. There's all these endless departments. You'd think that financial planning and knowing what is happening with the country's finances is like a really important thing, to a point where you would try and look at it more than twice a year maybe. There is the Office of Budget Responsibility, the OBR. There is the Treasury, right? There is the Institute for Fiscal Studies. There is the Chancellor with their entire department. There is the National Institute for Economic and Social Research. There is the Office of National Statistics. But the forecast for how the country is doing financially only happens twice a year, because why bother? Imagine if a big company only looked at their bank account and financials twice a year. Right? So everything is crashing and burning around you. Your company is doing really badly. The share price is collapsing. The cost of borrowing is exploding. And you just sit there and you go, well, it's another 5 months before we go and look at the data again, so we'll just wait. We'll just wait and do nothing, because that's the next time that we're going to get new data. I mean, what the actual fuck, seriously? We have computers and systems, right? What does the OBR do? How do they make these forecasts? Do they chisel them out on stone tablets using an abacus? What do the 52 members of staff at the OBR do exactly for the 6 months between the budgets and the statements? And if 52 people is not enough, why is it not 520 people to make sure the data is updated continuously? I just don't get it. I don't understand why we have to do things in such a backward way in this country. Anyway, the point is that the market thinks the UK economy is in trouble. We have seen it in the data. Services inflation is not going away. It is very sticky. It is still very high at 5.7%. Wages are going up fast despite the economy flatlining. This is not a good thing at all. And there is now a very real risk that the Bank of England is going to have to pause with the rate cuts, despite recently saying they're planning for more rate cuts in 2025, because inflation is on the rise again. It went up 0.3% in the most recent month for which we have data. Wages are rising, and we have a very real wage price spiral going on. Companies are being hit with increased taxation on top of wage increases, which is preventing investment in the UK. GDP did not grow in Q3, and the most recent data says that the economy shrank by 0.1% in October, the first month of Q4. The budget came in at the end of October, so the full implications of what was announced in that budget will only be seen in data from November onwards, so we haven't even seen it yet. And it'll probably take some time to come through, because it takes time for companies to make their decisions, but it's not really looking good at all. The United States has also seen their treasury yields go up recently, and a lot of the most recent increase is down to people being concerned about the impact of the tariffs and what Donald Trump is going to do after he becomes president later this month. There are also concerns about the inflation in the US being sticky. People do say that. The media says that. But the reality is that the inflation situation and the wage growth situation in the US and in the UK are completely different. There is just no comparison. The US is doing much better, in case you're wondering. The UK GDP is about £2.8 trillion, and the debt pile is now 100% of GDP, so it's also £2.8 trillion. Now, if all of that debt was to switch to paying 5.4% interest, which is where the interest is right now, then the debt interest payments would go up 50% to over £150 billion. That's about 4 times as much as the UK spends on the defence budget, and almost twice as much as is spent in total on education. This is atrocious. Remember, if you want to get my course, The Investor Playbook, all about investing in the stock market, I'm running a 10% discount for the next week until midnight on Wednesday, 15th of January. There are weekly live sessions that you can attend and ask questions. Use the code HELLO2025 at the checkout, link in the description and in the pinned comment. And if you haven't done it already, please subscribe to this brand new channel to get all the updates on the UK economy, finance, etc., etc. See you later.